With a month to go until the financial year end, superannuation returns look poor as the ASX goes backwards. Council Assisting recommends the Star is unsuitable to hold a casino licence in New South Wales, and Commonwealth Bank says it's rethinking whether customers can use its app to trade in cryptos, while ANZ says it's pleased it didn't get into the buy now, pay later space. It's Wednesday, the 1st of June 2022. Welcome to Fear and Greed, Australia's most popular business podcast. I'm Michael Thompson, and good morning, Sean Aylmer.
Good morning, Michael.
If I sound happy at the moment, Sean, I am, because I want to share something with you now. This is a fantastic little piece of feedback that we received yesterday, and it's from a Fear and Greed listener by the name of Ryan, who wrote a post on LinkedIn, and he just posted this to his own contacts, his own connections on LinkedIn, and he wrote this. He said, "Want up-to-date Australian business news? Then the Fear and Greed podcast is a fantastic way to keep up to date. They also have a 5-minute edition called the Fast 5 if you're short for time. Hopefully we can help them break a downloads record this month." And you know what, Sean?
What?
Ryan has helped us to break a downloads record this month. In fact, we entirely smashed it for May. Fear and Greed across the entire slate of our podcast. So we have Fear and Greed and the Fast 5 and Safe Word by Fear and Greed as well. 590,000 downloads for the month.
Wow. Our goal was 500. We're pretty confident we're going to get 590,000. That's smacking it. That's 20% more. Well, maybe not 20%, but just about 20% more.
Yeah, that's not too bad, is it? And so, look, thank you for listening to Fear and Greed, for promoting it to your friends, to sharing it with your colleagues, because so much of our growth has been through word of mouth. So we're very, very grateful to anyone who has told someone else about Fear and Greed. And please, let's try and make June another record month. I feel like I'm getting greedy for growth now, Sean.
Oh, yes, I know what you mean. I'm very much like 590. It's so exciting to get there. But as soon as you say it, I'm thinking, no, next month's got to be 600.
Yeah. Growth is good, right?
Growth is good.
Now, immediately after the show, I've got an interview coming up, and I don't want to say that you are driven in any way at all, and I've said this before, by kind of self-interest, but there is a bit of a coincidence here. The fact that we started talking about you doing renovations to your house and challenges finding tradies to get the job done. And all of a sudden today, we're talking to Robbie Sharon-Zipser, who is the founder and CEO of High Pages, which is just this tremendous success story, a platform basically for tradies in Australia that has just been an absolute success over the last couple of years.
That's exactly right. And it was total self-interest. I need tradies, and Robbie gave us the lowdown on what's going on in the market. He also said that at some point in the future, it's actually going to be easier to find tradies, which was a bit exciting for me because we're only at the council part of it. But a really interesting chat about how small business is operating in the Australian economy at the moment.
Yeah, no, it is. That's coming up a bit later on. But first of all, the main story this morning, Sean, is really all about the market. So with just a month to go now until the end of the financial year, the S&P ASX 200 is trading below where it started the year, meaning poor returns for people's super funds. While some of the best performers on the bourse won't surprise, and really we're kind of talking there about the lithium and battery metal stocks, other stocks such as the coal miners have shocked almost everyone.
Yes, it's been a pretty incredible financial year so far, starting amid COVID restrictions and lockdowns and ending with higher inflation and interest rates. In the middle, there's been a tech sector crash, a war in Europe, soaring commodity prices, a major cryptocurrency sell-off, and plenty more. The S&P ASX 200 finished last financial year trading at 7,313 points. Yesterday, it closed about 1% lower than that. Now, that hides some really big moves. Over the past year, the battery metals groups like Lake Resources, Core Lithium, Pilbara Minerals, Alchem and Lynas Rare Earths have been really strong performers, definitely as a group the best performers. Then comes the coal companies. Who would have thought that? Remember in November last year, ahead of the COP summit in Glasgow, no one was buying coal companies. They couldn't find a friend. Then we had the energy crisis, encouraged by Russia's invasion of Ukraine. They're now market superstars. Whitehaven Coal and Yancoal, along with New Hope Corporation, are three of the best performers of the top 200 over the past 12 months. And that's all happened really this year.
Yeah, it's pretty remarkable, isn't it? But what about the large cap stocks, the banks, the big miners and the big retailers?
Not really the place to be. Now, of the large caps, diversified miner South 32 has been the best performer, up nearly 70%. Incredibly good effort over the past 12 months, that is. Of the big financials, Macquarie Group has done best, followed by National Australia Bank. Both BHP and Commonwealth Bank are up 5%. That's better than the overall market, but it's not exactly a cracking year. Now, Coles is up by about the same amount, and it's done much better than Woolworths or Wesfarmers, both of which have lost ground this year. Telstra we always like to mention because it's such a widely held stock. It's up about 10% over the past year.
What about the tech sector, Sean?
Well, perhaps surprisingly, many of the tech stocks have actually had a good 12 months. While they've fallen really hard in recent times, they ran even harder before then. So WiseTech Global, for example, Computershare you can put into this basket, they've both done pretty well. Now, moving away from the tech stocks, Flight Centre has been the best in that sector. Vicinity Centres, that owns all those Westfield malls, that's done best among the real estate investment trusts.
All right, so what about the other end, though, Sean, the worst performers over the past 12 months?
Well, it's quite an eclectic bunch. If you ignore Tabcorp, which hived off its lotteries business and was easily the worst performer, down 80%, but that's only because it's about 20% of the company it was 12 months ago. So ignore Tabcorp. The worst performer is Magellan Group. Its high-profile CEO stepped down earlier this year and investors took their money elsewhere. Its share price tumbled. Domino's, though, that was another really poor performer. It's trading at less than half what it was in September last year. Domain Holdings, a real estate group, Fisher & Paykel, the healthcare company, Ansell, Xero, they've all done really poorly. And some of these, particularly Domino's and Xero and Fisher & Paykel, people loved them 12 or 18 months ago. Over the past 12 months, those three are three of the worst 10 of the top 200.
Okay, so what does all this mean then for superannuation returns this year?
They're just not going to be anything like last year. Now, admittedly, returns last year were the best in about 35 years for some funds. I mean, Aussie Super's balanced option, for example, returned 20% or a little over 20% in the 2021 financial year. The numbers this year are going to be way, way south of that.
Sean, I have to ask you, what's the moral to the story here?
Well, I'm not sure. Investing's hard. I think that's probably it. I mean, there's just no sure thing. See a financial planner. We always talk about that, and we're great supporters of professional advice for all investors. We are not an investment podcast, so go and see a financial planners. The good ones, they do tend to have the same advice. Invest for the long term. The adage of it's time in the market rather than timing the market. You've got to stay disciplined, understand what you are comfortable with, how you can sleep at night with comfortable investments, and you've got to stay disciplined to that, and you have to diversify to spread your risk.
And just before we leave the equity market, Sean, where did the ASX finish yesterday?
Well, the S&P ASX 200 closed down 1% to 7,211 points, giving back much of the gains of Monday. Financial and technology stocks were among the worst yesterday, with telcos also sold off. It was pretty broad-based, though. All 11 sub-indices ended lower.
Now, Sean, the Aussie dollar has pushed back above 72 US cents.
Yes, and the Commonwealth Bank expects it to head towards 76 US cents by the end of the month. It's now more than 4 cents above its low last month. It was last in the 76 US cent region in early April. Now, the reason for the rise are forecasts of higher commodity prices. Those forecasts gained some support yesterday when China announced less than 100 new COVID cases and also an easing of restrictions with manufacturers in Shanghai allowed to resume production from today. Now, that city also has a 50-point plan to revitalise the economy. Of course, if Shanghai and the rest of China picks up, they need our commodities. Great news for the Australian economy. Yesterday, a bunch of commodities rallied. Nickel led the base metals. It jumped 8%. Iron ore futures were also higher. All that supports the Aussie dollar.
All right, massive start to the show today. We'll be back in a moment with the rest of the day's business news. Sean, Federal Parliament will return on July 26th, and it looks like Labor will hold 77 seats, which is enough for the government to appoint a Speaker of the House and still hold a majority. In the meantime, Prime Minister Anthony Albanese is heading to Indonesia this weekend.
Yes, fresh from getting the much-desired majority, Mr Albanese will head to Jakarta along with Foreign Minister Penny Wong, and then in the next couple of weeks, Papua New Guinea. Can't say the new Prime Minister isn't focused on the region. He spoke in Canberra at the first meeting of all the elected Labor parliamentarians yesterday. That's the first gathering since the win last weekend. Mr Albanese said he wanted his caucus in this parliament to be defined by planning, faith, and solidarity. He yesterday claimed the 76th and 77th seats needed for an absolute majority in Parliament. Only Deakin in Victoria is still too close to call, and most market watchers don't think it'll go ALP. That would mean that the government ends up with 77 seats. Meanwhile, Treasurer Jim Chalmers said he's spoken to the Business Council of Australia, the Australian Council of Trade Unions and regulators to address big economic issues. He said he hopes to find common ground through a jobs summit, which of course was promised during the election campaign.
All right. Now, our main story this morning, Sean, was about how poorly the equity market has done this year. Now, the housing market is joining the party as well, with some cities recording price falls last month.
Yes, Sydney particularly. House prices in that city fell by 1% through May, the biggest monthly fall since January 2019. It was worse than any month during the pandemic, according to CoreLogic, and reflected deteriorating affordability and the recent rate rises. Now, if such falls continue, it would mean the country's largest housing market is on track for a 10% decline this year. Melbourne also posted a fall last month of 0.7%. Its trajectory isn't quite as bad. Now, Brisbane has been the market leader in terms of appreciation or price rises, but the rate of price growth is slowing there as well. It's gone from 1.7% a couple of months ago to 0.8% last month.
Okay. Now, there was a fair bit of economic news around yesterday, Sean. Building approvals fell by more than expected, down 2.4% in April, while private sector credit was higher than forecast.
Yes, approvals for new houses fell sharply in New South Wales and Queensland, but they were up in South Australia, Tasmania and Victoria. It followed a really big drop in March. Also, company gross operating profits rose 10% during the March quarter. That's all according to the Bureau of Statistics.
But the big surprise yesterday was really the reduction in the size of the current account surplus.
Yes, economists expected a $12 to $13 billion surplus, but it came in at $7.5 billion. It was the lowest since late 2019, and it reflected a surge in imports. Now, one product which added to the import number was COVID-19 tests. I suppose it makes sense, though when you're talking in billions of dollars, you don't think they're going to cost that much. Anyway, the Bureau pointed out COVID-19 tests as adding to the import number. Notwithstanding, we came in at $7.5 billion, and it's lower than it's been for a while. Australia has now recorded 3 years or 12 quarters of surpluses, which is the longest run since the 1970s.
Sean, you said economists were expecting a $12 to $13 billion surplus, but it came in at $7.5 billion. Do you reckon there'd be like a sense of disbelief when that number comes through? That it's going, surely this has to be a typo. That is so far off what was expected.
Yeah, I must say with this, though, because there's such big, lumpy numbers in imports and exports. So, for example, BHP may suddenly fill an order 1 month of coal or iron ore, which is worth $1 billion in itself or billions of dollars in itself. It's very difficult to predict. We'll have to get Stephen Kukoulis, our resident economist, to explain it to us even better. But they're very, very lumpy, some of those trade data. So they probably don't think it's a wrong number, but I think they're probably surprised that it's so low.
Well, I suppose, all these economic numbers can be somewhat difficult to make sense of, but really today we get the March quarter national accounts, the big one.
Yes, this is the big one. All the economists love this one. The national accounts showed what happened in the economy during the first 3 months of this year, how fast it grew, how well households were going, how much businesses were investing, how much trade Australia was doing. It's really a complete snapshot. It should show a slower quarter due to floods and COVID restrictions, but overall, the Australian economy, I think, is travelling along okay.
Sean, closing submissions in the New South Wales probe into Star Entertainment commenced yesterday, and the counsel assisting, Naomi Sharp SC, said Star had not yet undergone deep reflection on what's gone wrong. How is that possible?
Well, she and her team of barristers have recommended the inquiry chair, Adam Bell, SC, find the gambling giant is unsuitable to hold a casino licence, and the company is only at the beginning of its journey journey to remediation. Now, presumably by company, we mean the people within the company, and they're the ones that need to undergo that deep reflection. Ms. Sharp said the Star should not enjoy the privilege of a casino licence until it fixes its practices, according to media reports. Of course, such a finding would mirror what earlier inquiries found about Crown Resorts. In that case, in Western Australia and Victoria, the business does continue to operate, notwithstanding those findings.
The Financial Review is holding its annual banking summit. There's plenty of heavy-hitting financiers speaking and attending, and the boss of APRA, Wayne Byers, yesterday told the conference that the economy is entering a very different environment than much of the past decade.
Yes, he warned that faster than expected inflation and interest rates will hit mortgage borrowers and there'll be pockets of stress. He said APRA, which of course stands for the Australian Prudential Regulation Authority, is monitoring the potential repayment shock that will occur when fixed rate borrowers roll off to higher variable rate loans. Apparently over the next 12 months, there will be many fixed rate home loan borrowers, which have to move on to variable rates, which will be higher than what they've been paying. Overall, Mr. Byers said he was fairly comfortable with the state of the home lending market.
NAB boss Ross McEwen told the conference that he's worried about the construction industry.
Well, the bank hasn't seen any deterioration in its loan book to that sector yet. Mr. McEwen said the industry was particularly vulnerable to insolvencies given the supply chain difficulties, high labour costs and rising input costs for steel and timber. We've heard a bit about that in recent days.
Commonwealth Bank boss Matt Common was also there, and he said that while the bank still wants to allow people to trade cryptocurrency on its app, the sell-off in digital currencies is causing some problems.
Yeah, it was interesting. Mr. Common said a lot of air has gone out of the crypto sector, and to allow trading, Commonwealth Bank wants to make sure that people truly understand the complex and risky asset class. He said there was still plenty of enthusiasm to trade digital currencies, especially among young men. Maybe they're risk takers or something or other. He also said, though, that the sector had a long tail of rubbish. What he really wants to ensure is that people using the Commonwealth Bank app to trade cryptos and know what they're doing.
And the head of retail banking at ANZ, Miley Carnegie, said she's happy that her bank hasn't jumped into the buy now, pay later space.
Yes. Now, remember last week, National Australia Bank launched its offering in that space. Commonwealth Bank launched Step Pay a couple of months ago. ANZ has debated the merits of buy now, pay later, but resisted. And given the rising bad debts and investor anxiety, Ms. Carnegie is happy they did. She said buy now, pay later can be a great budgeting tool, but there's a bunch of customers who use it in a toxic kind of credit way.
All right, now one more, Sean, from the Banking Summit. We don't normally associate the Financial Review with protesters, but the venue yesterday had to contend with climate change activists, both inside and outside the venue.
Yes, I worked at the Financial Review for many years. Never did we ever come across a protester. I'm quite envious.
Maybe it's because you kept them all out, Sean.
Maybe. The quality of my content wasn't quite what it is now. It was interesting. There were a bunch of protesters from school kids through to adults. The protesters asked the bosses of the big banks to explain their attitude to climate change, particularly their lending policies. It certainly provided plenty of excitement for a banking conference, I've got to say.
Yeah, sure did. Now, moving on to overseas news, Sean, and China has watered down a proposal to implement a region-wide security pact in the Pacific Islands after the initial concept was rejected.
Yes, the most recent 15-point position paper has removed its original proposal for joint police training and law enforcement cooperation between China and Pacific nations. But China said it still wants to help combat cybersecurity and non-traditional security threats. The new paper also removed a proposal to establish a China-Pacific Islands free trade area and a Chinese-controlled satellite system for maritime surveillance. China's Foreign Minister Wang Yi was scheduled to visit Tonga yesterday. His trip continues. Whilst there were certainly ambitious plans from Beijing about what it might achieve, I think they've been hosed down now after some resistance among Pacific Island nations. I'm sure Anthony Albanese is pleased to hear that.
Yeah, I'm sure he would be. And one last one, Sean. European Union officials have agreed to pursue a partial ban on Russian oil.
Yes, that opens the way for a sixth package of sanctions against Russia since it invaded Ukraine. The sanctions won't allow the delivery of oil and petroleum products from Russia to member states by sea, but there is a temporary exemption for pipeline crude. It means about 2/3 of Russian oil will be banned, which of course will be very costly to Moscow. It also means that crude prices are going to remain high. And if we want to bring it back to what that means for you and I, petrol prices will remain high.
Thank you, Sean. I always appreciate it when you just relate every story back to me. Self-interest always wins out here. It's really been a bit of a bumper episode today, unintentionally, I think, but let's say we did it deliberately to mark our record month for May. But up next, the Fear and Greed Daily interview, and today you're speaking to Robbie Sharon-Zipser, CEO of hipages.
Self-interest. I'm doing renovations. I need help. Yes, look, hipages is a great online marketplace for tradies. The great thing is that Robbie's quite across what's happening in the different areas of the trades and where there's demand, how small businesses are operating. It's a really great insight into that sector and how small businesses are going.
Yeah, it's coming up next in the Fear and Greed playlist on your podcast platform or at fearandgreed.com.au. Thank you, Sean.
Thank you, Michael.
It's Wednesday, the 1st of June, 2022. Make sure you're following the podcast. Join us online on LinkedIn, Twitter, and Facebook. And if you haven't already, have a go at listening to us via your smart speaker. Just say, play the Fear and Greed podcast. I'm Michael Thompson, and that was Fear and Greed. Have a great day.